Hello, and welcome to your Daily Five. I'm Greg Harmon, founder and president of Dragonfly Capital Management. At Dragonfly Capital, we manage portfolios for clients using a combination of technical analysis for trade setups and options to create leverage and protection for trades that we run in separate accounts for clients. We also write and sell a newsletter for those of you that have an interest in learning how to trade on your own account using those same techniques. So detailed technical analysis with triggers, stops, and targets for profit taking. Find out more at dragonflycap.com. Today, our topic is how low can it go? We all know now that the stock market has been dropping, either from a very steep perspective, if you're a short-term trader who's been in and out of the very fast-moving tech names like the SaaS stocks and things like that, or on a slow grind lower if you're more in tune with owning the Dow Jones Industrial Average. There's a few things that I wanted to point out today as we go through this to take a look at and watch as the market keeps churning and not giving us a clear view as to what's going on, for us to think about where we might see a turning point ahead of the actual turn happening and ahead of the noise that we get from like the Federal Reserve and from the media about where the turns might happen. So let's start with this weekly chart of the US dollar index. So the US dollar index, a broad trade-weighted sampling of how we trade against all of our foreign counterparts and the value of the dollar against the combination of all those currencies. What we can see from looking at this is since 2015, so like a 7-year cycle, the dollar has been moving in kind of a range between a value of 89 and a value of 104. And prior to that, and left of the chart that you don't see here, it was much lower. So we had a rise up into that 2015 high at right about 101 to get into this range. What has been happening now recently, you can see the rise of the dollar here, up to 101.77, closing in on 102.5 today, but closing in really on the top of that range up at 104. And as we start to move to the top of that range, we start to see that the RSI is starting to get overbought, starting to get really hot on the momentum side. And the MACD as well, down here on the lower right side of the chart, is starting to approach the 2017 high, not anywhere near the October highs of 2015 highs, but the range highs. So we're at a situation where we're possibly topping out and starting to slow momentum as we get into this range again. Will the dollar stall at 104 again and then start to revert back lower? That's something to look at to see what the broad market is anticipating in terms of how the economy is going to turn, if it's going to turn, and what we should be looking at for the near term. The second thing I wanted to point out is the yield on the US Treasury 10-year note. The 10-year note, you can see bottomed out during the COVID pandemic at about 50 basis points, but had been falling for quite a while going into that, from 2019, 2018 into that bottom as things were flattening out. Since that bottom in the summer of 2020, the 10-year note yield started rising as the economy was thinking about coming back into focus, as we were starting to open up. And then we had this little bounce step back down, kind of a digestive bounce. This kind of created the neckline of a potential inverse head and shoulders. And what I want to point out is that from July 2021 onward, this is when we first started hearing about inflation being bad, and that the market participants, and particularly here, you can see bond market participants believing that the Federal Reserve needed to do something, and the bond market started tightening its perspective, started raising rates at that point. We did see a bounce through the neckline of this head and shoulders at the start of 2022. And it's not as obvious because there's a log scale here, but the move up to last week's rates at just under 3% is exactly the projected move out of the head and shoulders. So it's not unusual for us to see the pullback that's happening this week and the peak in momentum and the start of the sell-off in momentum as well. This is going to be a very important item to watch, I think, in terms of where we're going to head with the direction of equities in the future. If we do see that this is a short-term top in the 10-year note at the 280 to 3% range, and we start to see a pullback here, that would be probably a positive sign for the market. In that it would be, I think, an indication that the market is starting to feel that the Federal Reserve is on track and that inflation will be under control sometime shortly. Now, where's the pain been felt? The Nasdaq is where most of the pain has been felt, and you can see that rising from the 2020 pandemic low up to the top in November last year. If we put some Fibonacci retracement bands on this, you can see that we've had a strong pullback in the Nasdaq, and it's retraced 38.2% of that full move higher from the pandemic low. What's more is that it bounced at that 38.2 level up to a lower high and is now back down to that same level, but we don't see any let up in the sell-off here, right? 1, 2, 3, 4 weeks of solid red candles back down to that 38.2% retracement level. If you've been in the NASDAQ and focused on the NASDAQ, you felt a lot of pain during this time frame. Where is this going to settle? It may settle at the 38.2 retracement level. We're starting to see momentum back at near the oversold levels. But given that the MACD is turning lower, I would expect that there's probably still some more pain that we're going to see in the short term, at least in the NASDAQ. And where could it go? Well, I think that the Fibonacci levels are good levels to take a look at in terms of the potential. Not a prediction, but there's probably more possibility of pain in this sector of the marketplace than others. If we move into the S&P 500, you see that same time period from the pandemic low to the top at the end of 2021, we've got the same kind of general shape, a pullback and a bounce to a lower high, and then a 4-week pullback to test that same low, but nowhere near the 38.2% retracement level. In fact, the S&P 500 is about a little less than 25% retracement at this point. So a long way to go to get to that 3,800 level if it were to try and make that same kind of retracement. What's probably more interesting to me is the RSI, and the RSI bottoming just under 40, not deep down, not down like we saw down in the pandemic low under 30. To me, moving from a bullish scenario to get into a bearish scenario, the RSI needs to get and hold under 40, not just under 50 from my perspective. It is a little troubling, though, that the MACD is down here in negative and continuing to fall after avoiding a cross up and turning back down lower. So possibly more pain in the S&P 500 as well. If you do see a crack down here through the 4150, 4120 level, possibly down to 3819. And then finally, the blue chips, the Dow Jones Industrial Average. Same shape here, bit flatter in terms of the top, with a little spike at the end of the year, and a retracement of about 25% of the move higher as well, but not back yet to test the lows of that drop from the March-February timeframe. A little bit better holding up than the other indexes. So it seems as though the larger cap the index, the more industrialized, the more non-tech focused is where the money is the safest at the time. And of course, that could all change next week, but this is what it's looking like right now. So this is what I'm looking at and what I'm following. And that's your Daily 5. Thanks for watching.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.